And good afternoon. Welcome into Market Talk for Wednesday, April 28th. Great to have you here with us. MarketTalkAg.com. That is our home on the web, MarketTalkAg.com. A good afternoon once again. I'm your host, Jesse Allen. Find us on our website, all of our social media links. You can find as well all of our streaming sources, Spotify, Apple Podcasts, iHeartRadio, and more. You can also find all of our radio affiliates there and so much more. It's a one-stop shop, MarketTalkAg.com. Well, another volatile day in the trade. We saw a late session collapse in grains after we saw plenty of bull spreading and just a lot of factors in today's trade. We're going to talk about all of it with our good friend Mike Zuzolo with Global Commodity Analytics. Mike, good afternoon. And, it was looking like an okay day until about the last half-hour trade, and then this grain market, for the most part, just fell apart. That bull spreading just kind of went away today.
Yeah, get used to it. I mean, that's really the heart and soul of what we're going to be seeing, Jesse. You and I have been talking and warning about this, and it's really a sincere issue when it comes to the expanded limits coming on Monday and this idea of catching a falling knife when the markets do decide to break because the funds are so heavily involved futures wise. And Wednesday, especially, what I noticed two things was the volume was much lighter than it was on Tuesday's trade. And that tells me or suggests to me there's a lot to trade still when it comes to the momentum and the sentiment indicators. And that makes sense fundamentally because I think what really turned the market sharply higher is, and you can see this by what went limit up. We had May corn go limit up. We had May soybean oil go limit up. What would have driven those two commodities to go limit up? Well, they're both energy related. We had energy weekly numbers from the Department of Energy, and we saw ethanol stocks go down, production going up. Not a lot, but at $7 corn, how can the ethanol producers be increasing their production? Well, because their margins are still so strong because ethanol and unleaded prices are suggesting blending by refiners. So stocks of ethanol went down and we're, I think, now less than 130,000 gallons from hitting last October's lows, which was a 4-year low in ethanol supply. So again, like we talked about last week, we're heading into summer driving season. We keep seeing ethanol supplies go down. Similarly, distillate heating oil stocks went down about 3.3%, I think, versus last week. So they're starting to hit 2-month lows right when we come back from the pandemic. And the truckers, the demand that we're going to have on the economy if we come out of this pandemic and restaurants start opening again, trucks are going to roll. So I think that really explains the vast majority of the strength early on. But and obviously there's weather always in this market during this time period. I don't want to minimize that. But I think the energy play really helps explain why the close was so much weaker. And I think they played the energy to the hilt. And we noticed that it was getting late in the day. And guess what? The Federal Reserve gets ready to talk at 2 o'clock Central Time. And they're getting ready to give us an update. And I think they're, at 1 o'clock Central Time. And that's really, really critical every single month to the grain and oil seeds, the dollar, the energy markets. And I sense that there is a real big shift ahead of the Federal Reserve. On top of that, the macro side is going to present us with fresh information by President Biden speaking tonight, Wednesday night, about the fiscal stimulus bill, about the infrastructure bill. That's all inflation. That's all taxes. So I saw a real dramatic shift after about 1 o'clock Eastern time. And as we went into the close, especially 1:15 Central Time, we saw a lot of orders being pulled and the breaks started to occur to the downside. And I think the trade was real nervous about the Federal Reserve, especially.
And that's a great point that you make, and something that sometimes we don't consider with all the headlines about weather and things of that nature is all those outside macro factors in the energy market as well. Now, I'd like to hit on just the fact, you mentioned expanded limits coming next week. We have first notice day here Friday for May contracts. Obviously, the strong domestic basis. I mean, that's making owning the delivery month a viable option. That think kind of contributed to the bull spreading we saw today.
Yeah.
But looking at this, market here, with it being so elevated, I'm wondering. We've seen the breaks get bought back here pretty quickly when we have a correction like this. I'm wondering though, Are we finding a top in this market possibly, or is it just going to continue to be volatile with no top in sight?
Yeah, if I add one adjective to that question, are we fighting a demand top in this market? I think yes, we are. I mean, I think that's where Thursday we're going to come back and we're going to trade weather, number one, weekly export sales, number two, and tied for second is going to be the Federal Reserve and what they actually did say and what the dollar was doing and what the Brazilian real was doing and what the Chinese yuan offshore market was doing after they got done speaking and whether essentially we were heading towards the March lows and taking out the March lows or getting close to it in the dollar index. We were heading towards a fresh 10-week high in the Brazilian real as the Federal Reserve got done talking, and we were heading towards a fresh 8-week high in the offshore Chinese yuan. And so that's all commodity friendly because that's emerging markets going up and the dollar going down. And it makes sense with the Federal Reserve saying to you, hey, look, we see a recovery. We see inflation that's transitory, but guess what? We're going to keep buying $80 billion a month of treasuries and $40 billion a month of mortgage backed securities. That's inflationary. And as long as the currencies point in that direction, I'm not going to fight it. So, yes, from a standpoint of supply demand top, I think we are hitting that level at these prices. And I think that's why, since you and I talked last Wednesday, the May corn has gone up $1.16 from the last Wednesday low to the high on this current Wednesday that we're recording. The May beans has gone up $1.41. And so that's the kind of parabolic move you and I talked about to be looking forward to. And in essence, we've pulled off 40 cents off the corn top and 60 cents off the bean top. Why'd we do that? Well, I think there's two charts that we're going to talk about here. Whichever one you want to put up first, we can go through that and kind of explain that demand mindset and that topping mindset.
I think let's talk the soy chart here because that was going to be the next story I was going to go with, and we're hearing some rumors and of imports of beans into the southeast part of the U.S. So why don't you talk about that a little bit?
Yeah, and this is really tough to talk about, and I have to say these are all rumors. This is all market chatter right now, but it's coming from some pretty good sources. I have not one but two potentially big livestock feeders are looking at bringing soybeans in from Brazil to the United States southeast. As you said, Wilmington bulk would be the natural place to bring that in at, or maybe Savannah. But this is the reason why, Jesse. I think your question is real pertinent. Brazilian beans are literally $40 to $50 a ton cheaper than U.S. beans right now. And this is why the currencies become so important, because if the Brazilian currency starts going up and the dollar starts going down, that opens the door for more upside for the bean futures market here in Chicago or here in the United States. But right now, we hit over $600 a ton earlier this week in U.S. soybeans at the Gulf of Mexico. That takes you back to levels not seen since 2013, which is the very left edge of that chart. And so this is your demand base being eroded, and this is why the feeders, the poultry and livestock feeders, are trying to come in and bring imports in. They're trying to break this market's back. And so I said to clients earlier this week, the best cure for high prices is ... imports. Yeah, it's high prices, but it's really imports. And so if we do physically see imports and we would happen to see a negative export sales week on Thursday in soybeans, market will put two and two together and say, wow, we've really taken this to a level at the Gulf of Mexico, and Brazil must have the crop that they can ship it up to us.
That's a great point you make there, and I want to talk as well about the other chart you sent me, this wheat corn spread. I think this all kind of correlates as well. Why don't you talk about this a little bit, Mike?
Well, this is where I've got three horizontal lines here, and it kind of distinguishes for me visually when the wheat market gets really revved up and leads the corn higher and vice versa. And so when you have soft red wheat go at 45 cents is kind of the baseline level since we came out of the lows in 2013. And you notice that the wheat led the corn in 2012, but then the corn took over as a leader in late 2012 into early 2013. And then the wheat just came on like a house of fire. And that's something I would not be surprised to see happen again this time around and this year, later in the year, Jesse. But when the wheat explodes to the upside, you simply just don't have to worry about wheat becoming a feed grain. And you're not going to see very many stories of China or Vietnam or the Philippines or the United States looking at feed wheat and trying to source that instead of corn. The reverse is the case right now. And that's where this dotted black line comes into play. We have essentially, since the end of 2014, 2020 or the beginning of the fourth quarter of 2020, been on a mission in the market to get corn feed out of the mix. And we've done an unbelievable job. We've essentially gone from $2.20 premium soft red wheat down to under 40 cents, and underneath that key 45-cent support level, which is designated by the 2016-17 lows, and also kind of clips in there where the 2012, 2013 highs were before we blasted off in 2013. Now, the bad thing about this is that if you look at this chart, you've got a lot of air below you. In other words, there's not a lot of support now on this chart until you get down to around negative 30, negative 50. That's where we were on closing bases in 2012, 2013. We went down to 35 and a half or 35 and a quarter negative in 2013 on a closing basis, which this chart shows. And then negative 58 and a half on a closing basis was the ultimate low in 2012. So this suggests to me wheat is not going to be a friend to the corn unless we come into harvest and we don't find the yields out there that we were expecting. So beware if you think we're going to go above 720 corn at this point. It's going to probably have to be on corn weather, not the wheat leading us higher.
Well, and that's going to lead me into another question I wanted to ask you today, Mike, is that, we know that for the most part, the old crop bushels that are left out there, a lot of farmers are just kind of, hanging on to them. It's not a big amount. They're kind of just, they're gambling with them.
Mm-hmm.
New crop side, though, I'm hearing more and more chatter from producers when we talk weather. They're getting a little nervous about marketing too much new crop at this point because they're worried they might not produce it with how dry we are, especially west of the Mississippi River and the long range forecast models. There's a lot of opinions out there and varying models out there. What do you say to that as far as producers looking at their marketing and worried about marketing too much new crop right now?
I'd be worried about that too. And I've actually addressed that with the clients. And I appreciate you bringing that up because this is a year where we're on razor thin old crop supplies, as you say. And the producers have gotten used to the accumulator type contracts where they double up if prices go above a certain price level. And we haven't even planted hardly that much at all. And yet we are close. And this is actual producers calling me saying to me, I've oversold bushels already because some of my accumulator contracts are getting close to being hit, or I'm close to that level. And I'm going to be doubled up on what I was expecting to sell. And I'm real nervous, as you say, I'm real nervous, the producer says, of really overselling my bushels because of what's going on. And I'm right there with the producer, especially after May 10th, especially with the weather pattern we have right now. The weather pattern that the model said was going to be warm and dry in the month of May, and everybody felt like, well, we're heading into the month of May, so we're going to be warm and dry. Well, look what's happened. We're turning warmer, but we're coming off a major freeze, and we're seeing a big shift in a much wetter bias right at the wrong time period. So this week's planting progress for corn of 17%, that was a wake-up call to the trade because we're below the five-year average by a couple 3%. Not a lot right now, but you can really get caught behind the 8 ball next week if we see these kind of rains that the European model is suggesting. I mean, the difference between the GFS model and the European model right now, Jesse, is night and day in my opinion. You're looking at 2 inches of rain from the GFS model for the next 5 days, 4 inches of rain, and a wide coverage of Illinois, Indiana, Ohio, and almost all of Missouri, almost all of the Corn Belt of Kentucky and Tennessee. So, I mean, you're looking at some unbelievably heavy totals if the Euro model is correct. And that takes you then to the next 7 days out. And all of a sudden you're counting into, wow, I'm at May 5th and I'm not turning a wheel. And May 10th is right around the corner and no beans are still at 1330. Do I want to switch some more acres out of corn and into beans? So that's your answer to me is I'd be much more worried about the corn and the upside potential and not getting that in the ground, less worried about the soybeans. And the natural idea, and this is what I threw out to producers this week when I increased my sales in wheat and corn this week by about 10%. I said, start using puts, start getting floors underneath you. Don't sell your cash bushels, especially if you're in the line of fire by the heavy rains. And I think that's a really smart way to play it right now because we're not behind yet on planting. This could have encouraged enough planters to roll if Mother Nature gives us a chance. And I think it would encourage enough to get them rolling if Mother Nature gives us a chance. So keep selling, but don't sell in a manner that puts you behind the 8 ball in the physical shipments and having to buy your contracts out at your elevator.
And I think on the flip side of that, you look into the northern plains with how dry it is there. They're not catching these rains, and the
No.
models are really saying that they're not going to catch many rains, at least here in the short term. So I think that's the flip side is that, yeah, I mean, they still have good planting conditions. They can put it in the ground when it's dry, but you still got to have rain to make a crop.
No, you're exactly right. And I think this is where it goes back to you don't want to hem yourself in by being bearish or bullish. I had a really good client. We talk every single day. He's really on top of his marketing. And he said to me, he goes, I just can't sell right now because some of these guys are telling me we're going to $9 in wheat. And so I went through the stocks to use. I went through what you and I talked about just now with the spread. I went through the rational side and said, okay, that's my end. Your end is it's going to go straight up. Okay, let's meet each other halfway. Let's still hedge. Maybe we cut down on the amount of bushels we hedge, but let's hedge. Or maybe we go ahead and do a paper position, but let's still hedge because you're talking about $1,200 of revenue gross per acre in corn right now, and you're banging on $1,000 of gross revenue in soybeans. Just don't walk away from that just because of Mother Nature. That's the really we're getting down to it right now is that Mother Nature, we've got the inflation bowl in, we've got the La Nina bowl in, and so we've got the demand starting to be curtailed. It really is getting down to weather at this point, and you just don't want to market on the long side of this market if you're growing it based upon weather and weather alone. There's too many available tactics that you can take that can offset your risk too well to do it that way.
Well, great insight as always on the grain market. I want to flip to livestock. Give us some time to talk there. The hog market continued to rally here today. I mean, despite we're getting towards some long-term resistance levels in this market, but still a strong day on the hog market here today. And I've noticed we've started to build a little sideways range in here the last couple of weeks, but
Mm-hmm.
it still seems like just bubbling under the surface. We just want to take this hog market higher. We just haven't found that one catalyst to light the fire, basically, again.
Now, that sideways range bound trade that you bring up really is an excellent point because if you overlay a lead month soybean chart and a lead month hog chart, they look eerily familiar as far as sharp moves to the upside and they kind of balance themselves out and then they get prepared for another sharp move to the upside. I think it really is getting pretty simple with the hogs. The belly prices are dropping now. The sow prices, the sausage. I had a client tell me that a major sausage producer wasn't really taking sows this week. That's the first time in 6 months I've heard that. I think you're getting to the point where the fundamentals are getting overdone and that the hog market is overdone in general at this stage of the game from a supply demand standpoint, but you've still got the funds underneath you. So you still got the pork and bean trade by the funds underneath you as a result of that. And I think simply put, you're getting overvalue at this stage in the hog complex. And you're really getting to the point where you're going to have to feed the bull with fresh information. I think weekly export sales in pork is going to be a really big number this week again, like it was last week, because I do think you have to feed the bull. So I'm pretty negative the price action in the hogs, especially as we get into the month of May. I feel like the month of May is usually a cooling off period as the April market, as we've talked about, the April futures is now off the board.
I think we kind of know what's going on with hogs. You laid that out there really well, and that is really only those few factors in place here. On the cattle side, though, we've been getting beat up here. We don't like the higher feed prices, the higher grain numbers. Another lower day today, live cattle and feeder cattle trade. We saw some cash activity about $1 lower, but that was pushed out to the middle of May
Yeah.
here today. So, I mean, this cattle market, I feel for cattle producers right now because it just seems like we've taken a lot of momentum out of this cattle market, and now we're just kind of treading water.
Yeah, and we have, and a lot of this goes back to having to balance the market with the spreads and balance the way the speculators trade nowadays. I told clients today the wheat corn spread that you and I looked at today, it looks unbelievably similar to the feeder corn spread as far as going down to 2012, 2013 lows between that ratio of the feeders versus the corn. And what my charting software does, just as a little bit of a grass in the weeds, getting into the taller grass mindset, is the feeder corn ratio I use converts the corn into pounds so that it's not bushels against pounds, hundredweight. And so that's why the feeder corn ratio that I look at is very similar to the wheat corn spread right now in terms of how low we are. I think, Jesse, bottom lining it out is April feeders, May feeders. They've all come together where the cash index is as the April futures goes off the board this week. We have a very well balanced feeder cattle market now. I've actually been taking and recommending clients to take the poke at the long side here this week as we play the corn back and forth. In the fat cattle, it's the same, only a little bit maybe weaker because the fat cattle cash market, as you say, just has not developed yet. And I'm noticing offers are up there at 122, 124. You even see that at the reserve prices at the Central Stockyards auction on Wednesday. Reserves were 122, 123, 124. So you kind of have an asking price well above the market. You've got April fats that are trading right with the last cash trade that you mentioned. And then you've got June fats down at 115. You've actually got a pretty good discount in the June fat cattle. So I think both fats and feeders really are poised to go higher, especially if we keep seeing weights drop because of these high feed costs. I think it's just keep your marketings pretty current. I don't think there's a need to hedge here, though, at this stage of the game.
Well, Mike, great insight as always. Any other final thoughts you have for us today?
I would say the end of this week is the end of this month, and that's going to be a really important monthly close, again, because of what you said at the very beginning. We're going to see expanded limits, not so much in the wheat, but we're going to see big expanded limits in corn and beans. And that's going to really make that parabolic move up and down and that catching the falling knife more appropriate than ever. So be cognizant of where we close out this week at, because a technical sell signal to me is a technical sell signal. I'll still hedge it. I'll just give the corn more benefit of the doubt in case we stay wet.
Well, I know folks can reach out to you for advice, and you got a lot of great research and charts and insight and everything. Your website, globalcomresearch.com, and they can find all your contact info there as well, can't they?
Yes, they can, and they can sign up for a 3-week trial for free. All they got to give me is their name, their phone number, and the state they're at, and obviously their email, and that's it. And I'll contact you once at the end of the trial and won't bother you after that.
Globalcomresearch.com. That is com with 2 M's, globalcomresearch.com. Mike, appreciate the time as always. Thanks for joining us. We'll talk to you next week.
Thank you, Jesse. You too.
Mike Zuzolo with Global Commodity Analytics joining us here today for the Wednesday, April 28th edition of Market Talk. I'm your host, Jesse Allen. Have a great afternoon.